Pause for a moment and ask yourself, what is truly happening to the US dollar when the S&P reaches 7,000 while gold touches 5,300 US dollars and silver breaks above 115 US dollars simultaneously? This is no longer a routine price surge. It is the signal of a silent repricing wave spreading beneath the surface of global markets. Reports emerging from Shanghai, disruptions in physical metal flows, and a growing aversion to holding cash are converging into a fundamental question. Are we witnessing a turning point in the inflation cycle, or merely a defensive reflex of the global financial system attempting to protect itself? When markets light up in unison on trading screens, many assume they are observing a historic moment of collective optimism. Yet just beyond that glow lies a set of unavoidable questions. What force could drive the S&P to 7,000 while gold reaches 5,300 US dollars and silver exceeds 115 US dollars within such a compressed time frame? Movements of this nature can only be understood by looking beyond the surface of price action and into the market's underlying psychological infrastructure, where subtle shifts often reveal more than dramatic numerical milestones. Financial markets rarely move in this kind of synchronized fashion. Equities typically embody expectations of future growth, while precious metals reflect demand for protection. When both rise with comparable intensity, it signals that capital is attempting to exit a shared focal point: the US dollar. When the world's reserve currency is increasingly questioned in its ability to preserve purchasing power, all other assets temporarily assume the role of refuge. At such moments, prices no longer measure how much wealth investors are gaining. They measure how rapidly concern is spreading throughout the system. A review of recent corporate earnings offers no evidence of a profit shock large enough to justify the magnitude of the S&P's advance. What has risen sharply instead is demand for foreign currency hedging and institutional selling of US dollars. In effect, markets are not reacting to optimism about growth, but to the perceived risk of a reassessment in currency value. When the shared monetary foundation begins to destabilize, competitive behavior is driven by fear rather than confidence. Against this backdrop, developments in Asia add further tension. Manufacturers in Shenzhen report that for several consecutive days they have failed to receive industrial silver from Shanghai transit warehouses, despite having prepaid for deliveries. This is no longer a question of logistical delays. A leading global manufacturing hub cannot function without metal for an extended period unless supply flows are experiencing structural disruption. When a critical input, essential for solar energy, electric vehicles, and medical equipment, fails to reach factories, financial market prices represent only the calm surface concealing deeper turbulence below. For manufacturers, whether silver trades at 115 US dollars or 150 US dollars is irrelevant if production lines face the risk of shutdown. When physical supply tightens, price reflects only part of scarcity. The remainder lies in access itself. History has seen this pattern during wartime shortages and major supply chain breakdowns of the last century, periods when financial markets ceased to reflect real commodity conditions and instead obscured mounting stress. If Asia confronts material shortages, the West faces liquidity constraints. Despite rising prices, many distributors lack sufficient cash to absorb large metal lots brought to market by resellers. When prices accelerate faster than capital turnover, markets enter a dual state: elevated prices paired with impaired liquidity. This phenomenon was extensively documented during the metals crisis of the late 1970s, when price discovery and transactional reality became entirely disconnected. Two regions, two distinct pressures, yet together they reinforce a single upward force in precious metal prices. One side fears the absence of physical supply. The other fears the absence of real liquidity. When both pressures converge toward defensive positioning, gold and silver become focal points of global anxiety. This does not imply prices will rise indefinitely, but it does demonstrate that markets are adjusting to systemic instability, spanning monetary policy, currency credibility, and supply chain structure. Data on silver withdrawals from U.S. exchange warehouses show outflows far exceeding normal off-season patterns. This can be interpreted as institutions converting paper claims into physical assets, a strategy commonly employed during periods of inflationary stress or macroeconomic uncertainty. Still, it would be premature to declare a long-term trend. What is more certain is that markets have entered a phase where each ton of metal leaving storage carries significance beyond its nominal valuation. Simultaneously, large institutions are quietly expanding exposure to precious metal mining companies. As extraction costs rise and easily accessible reserves decline, control over raw resource supply can serve as a more resilient hedge than holding refined metal alone. This strategy has repeatedly emerged during periods of systemic repricing. Capital is not merely seeking safety, it is seeking strategic control. Viewed as a whole, these movements are no longer spontaneous. They exhibit rhythm, causality, and interconnected signals demanding closer observation. Price appreciation is only the surface layer. More consequential is the growing divergence between financial markets and physical reality. When asset prices soar while production struggles, the central question shifts from "where will prices go?" to "what is altering the fundamental structure of capital flows?" There is no simple answer. Markets are operating in an environment where every data point carries dual meanings. One points toward opportunity, the other toward risk. This complexity explains why gold, silver, and the U.S. dollar now occupy the center of global debate. No participant possesses complete information, yet each new signal provides a clearer cross-section of an ongoing process of asset reallocation. This narrative does not conclude with prices, it begins with perception. And it is observers themselves, watching market movements day after day, who pose the most critical question. Are we witnessing a temporary defensive reaction, or the early stages of preparation for an entirely new economic cycle? That is why the moment when the S&P touches 7,000, while gold and silver reach record highs, is not merely a price anomaly, but a reminder of how monetary history consistently responds when confidence in purchasing power erodes. What we observe today extends from prior cycles in which politics, economics, and global capital flows converged to redefine the role of the U.S. dollar and defensive assets. This does not mean the future is predetermined. It does suggest, however, that the door to a new phase is opening, one in which technology, energy, mining, and precious metal supply chains must adapt. This may represent only the opening chapter of forces that will shape the coming decade, from finance to space exploration and transformative technologies. So, how do you think this shift will influence gold, silver, and the long-term strength of the U.S. dollar? Share your perspective, because it is within the community that the most refined forecasts take shape. This is Money Cycles, where we examine the quiet yet most consequential movements of the global system. If you want to stay informed on the next inflection points, you know where to find us. The world is changing direction, and the path ahead, though filled with uncertainty, remains rich with opportunity for those who understand the rhythm beneath the surface.